Yeah, you're gonna take that class. I don't know whether with me or somebody else, but actually, let me see how am I doing in registrations. I mean, it's weird. This semester I had 30 people in this class. Next semester, not that. EKU Direct. And I'm on the direct connection. Oh, it went up to 8. It was 7. That's going to be a fun class. Let me see which one of you are in my 301. Not a single one of you. But sometimes, the assets are mispriced. When assets are mispriced, they will be off SML. Now let's think about, let me see, the pink one. Think of an asset, okay? Given its beta, the expected return is much higher than what SML would have implied, okay? Now, if CAPM is a true description of asset prices, this stock is yielding much higher relative to its risk, right? Beta. Or expected to yield much higher relative to its risk. Well, if that is the case, I'm an investor, I know this stock, I expect this stock to yield a lot higher compared to its risk, I'm going to go buy it. What happens when a stock, everybody wants to buy that stock? Its price is going to go up, right? That means this is an underpriced asset. Returns are too high, that means price is lower than it should be. The reason returns are high, price is too low. Think of it. I mean, prices are determined in the market, but what the company is independent of the market, independent of the stock market. Whether stock price is $5 or $4, the business of Microsoft is going to be pretty much same, right? They're going to sell this many Windows, this many Office, make some money on ChatGPT, what have you. So their expected future cash flow is the same, but the price that cash flow commands right now is too low. That's why expected return is high. But if there is a disequilibrium like that, market is going to move to remove the disequilibrium. As the price goes up, expected return starts coming down. So anywhere, anytime you plot above the SML, the asset in question is underpriced. Underpriced. if it plots below the SML, overpriced. Of course, given that CAPM is a good description of asset prices. I mean, in science, not that I consider finance a hard science, you always have models of things, okay? A model or a theory is as good as the predictions it makes. CAPM makes very specific predictions. It basically says the relationship between risk premium for an asset or portfolios thereof is linear, and the slope of that line is market risk premium. And it also says all the difference in expected returns can be explained by betas alone. Just like all models, these are approximations to reality. Now we know, based on the last 40 years of research, CAPM is not a perfect description or even good enough description of asset prices. But, you know, it's not too bad. At least you always know that if you have two assets, one is a higher beta, it's always the case that the one with higher beta has returned higher in the past, or even expected return. But sometimes betas alone cannot explain all the differentials. For example, historically, you look at, I'm not going to go over how I got it, but let me try to find it from my Finance 301 class, just to show you that it's not necessarily a correct description. I think we did it out here. No. Come on. Okay, this was an example. Let's see. This is an exercise where June of every year since 1926, you sort the existing stocks based on their market cap. You put the smallest 10% in the small cap portfolio, the next 10% on decile 2, and finally the largest 10% in large cap. And if you look at the average returns on an annualized terms, you make about 17.5% compounded for a year on small caps, but you make only 11.29 for large caps on average since 1926. Oh, I don't have the betas here. Let me. I don't have betas here. Come on, man, what happened to my file? Did I close that file? Anyway, suffice to say, you can't explain that so-called size premium of 6.25% a year by beta differentials alone. Roughly only half of that can be explained by beta differentials. That's because CAPM assumes that there is only one source of systematic risk, that's the market risk. But turns out, there are other sources. For example, small companies, independent of where market is, are more fragile in bad times, financial distress risk. But at least, if you look at it in terms of total risk, small cap stocks are twice as risky as large cap stocks. So, in that sense, the spirit of CAPM is there. The riskier it is, the higher are the returns. But if you did per unit of risk, this is not systematic risk, but still,